Trading finance. Today's video, we're going to talk about naked short selling. What is the short ladder attack? What's going on with the clearinghouses? We're going to clear some things up the best we can. And we got these video suggestions from, can you do a video on the situation with the clearinghouse, depository trust, clearing corp, collateral increases, and all the reason why the broker halted trading. And also, can you do an explain on short ladder attacks? Before I get into anything else, I never heard of short ladder attacks a day in my life. I never heard that term. I checked my books. I couldn't find it. Certain websites that I always check for research, I couldn't find it. There was only one source that I found that term, and we'll go over that in a little bit. So first off, in a simple way, what happens when you buy a stock? You have your broker, you have a seller, and they have their broker who acts as your representation to the clearinghouse. The clearinghouse is where all the transactions are finalized. It says, hey, this person wanted to buy Apple at $135.45. This person wanted to sell those same shares at $135.45. Clearinghouse makes sure that person A and person B gets exactly what they agreed upon. Okay, this is you. Now you have two options. You can have a cash account where that's all your money. When you buy on a cash account, it takes 2 days for that trade to settle. Or you have a margin account. A margin account is when you borrow your broker's money. It's settled right away. One scenario on why Robinhood stopped or halted trading, just one scenario, there could be a lot. The clearinghouse, who finalize the transactions, are getting a lot of volatility, and they're saying, hey, this stock is moving up too fast. We need to make sure that if your clients are buying on margin, that you have enough collateral to make sure everything is good. Because this stock could easily go up and then down 50%. Your broker needs to make sure that the funds are there for the transaction. So it's not their responsibility, it's the brokers. So that's why you'll see Robinhood raises whatever cash to fill for collateral. The clearinghouse wants collateral on your broker. We're gonna halt this trading, so it'll slow it down. So we all know what short selling is. You want to short a stock, you go to your broker, you say, I want to short this stock. If your broker has shares available to short, they lend you those shares and you short the stock. Those shares are disclosed, meaning those are authentic shares issued by the company. Let's say ABZ has 1 million shares outstanding. Those million are the only million that ABZ issued to the public. Anything above 1 million would be seen as counterfeit or fake shares. Some people say that's a good idea because it provides liquidity, but other people say it's a bad idea because you're inflating the amount of shares that's going around when they're not really there. So, there's some good and bad cases on it. Where do these shares come from? How do they become counterfeit? Well, I had to look it up. It says fails to deliver. If a short seller cannot borrow a share and deliver that share to the person who purchased the short share within 3 days allowed for settlement of the trade, it becomes a fail to deliver and hence a counterfeit share. However, the share is transacted by the exchanges in the DDC as if it was real. Now remember, these depository trust clearing corps are also owned by the prime brokers. They can work hand in hand to make so the hedge funds get what they want, regardless if it's legal or not. Since forced buy-ins rarely occur, the other consequences of having a failure to deliver are inconsequential, so it's frequently ignored. Enough fails to deliver in a given stock will get the stock on the show list. That's the SEC's list of stocks that is excessive fails to deliver. Penalties amount to a slap on the wrist, so large fails to deliver positions for victim companies have remained for months and years. The SEC, the Securities and Exchange Commission, they're like the police of the markets. They say, hey, that's insider trading, you're not supposed to do that. You're not supposed to do that. You're not supposed to do that. You stole billions of dollars from the American people? Give me a wrist. Go on your day. If you look at the track record with the SEC and hedge funds, they don't win often because with financial cases, you need hard evidence that something bad's going on. And there's a lot of loopholes in how to hide what's going on. And it's not so easy to find out. There are a lot of lawyers, a lot of smart people over there to make sure that they can get away with anything they choose. So we need to know who the players are. You got retail, that's the less money. And then you got the hedge fund. They got a lot more money, more influence, billions of assets under management. When they want to buy stocks, they don't go to Robinhood. They go to a prime broker. So the hedge fund goes to the prime broker. Because the prime broker has perks that the little brokers don't have, the Robinhoods don't have. And prime brokers like the hedge funds because they pay the big bucks in fees.
Let's just say Merrill and I have a good relationship.
You have a good relationship with Merrill Lynch.
And we'll say, for example, Goldman Sachs is our prime broker. I'm long Goldman Sachs, but this is just an example. Prime broker they use, Goldman Sachs, they have a DTCC, Depository Trust Clearing Corp, and it's pretty much owned by them. So the hedge fund works with the prime broker works with the hedge fund. The prime broker has its own private clearinghouse, which even the SEC, it's difficult to go in because you need subpoenas, you need all types of documentation. It takes a while. So when the hedge fund says, hey, I want to short some shares, you got any shares to short? The prime broker says, no, but we can make something happen because all we got to do is electronically move some things around. And we know since market makers have more time to deliver short shares, then we could, finesse the system a little bit. And the SEC doesn't really bother us too much because, hey, we're all under the same umbrella. We got Wall Street infiltrating every sector in the world, including the government and the presidential cabinet. So, we're safe. We're all buddies. Let's make some money. So what is a short ladder attack? And like I said before, I never heard that term before. I've heard of some different, variations of short attacks from different hedge funds, but short ladder was a term that I haven't heard of. So the only thing I found was this PDF that shows, that term. So we're going to use that as our reference. So we have two short hedge funds. They have a common goal with maybe a common big boss. That big boss says, hey, if you do this for me, we'll do this for you. And money talks, so they'll listen. They're incentivized to push the stock down. Short one pushes the stock down using these counterfeit shares, these shares that shouldn't even be in the marketplace, but they're there. So the stock goes down, let's say 295. And short two covers because they have a short position, and then they short some more, which pushes the stock down even further to 290. And it's a back and forth where they cover both sides, and then they just keep shorting with these counterfeit shares. So it's a back and forth pushing the stock down. That's what I got out of it. And then there's people who will say, hey, there's order books. Order books are where you have all these different prices from all these different exchanges, but the rules are you have to buy at the best possible price. But, they leave out the fact that, hey, this is finance and people are crooks all day long. You see the same crooks from 2007 who blew up the economy and only a few went to jail. So to think that people can't get away with stuff is ridiculous. So these short ladder attacks, both hedge funds start shorting the stock, it goes down. Now, that's easy to do when your broker restricts everybody else from buying. When you restrict it, there's no upward buying pressure. If you can only buy one share of the stock, but the hedge funds can short as much counterfeit shares as they want, there's no fight. It's not a tug of war match. It's a tug of war match between the strongest man alive and a baby. So where does that leave the guy with the shares? The person who wanted to diamond hand this thing, who wanted to hold the line, but now they're stuck with two options. They either sell or they're forced to sell if they're on margin. If they're on margin and then they just watch their position go down, their broker's going to say, hey, deposit more money or we're going to cut some shares to meet the margin requirement. So they sell half and then they watch it go down even further and then they have to close it out completely at a loss. This person didn't have weak hands. It's just, maybe they're not used to seeing their portfolio just blow up in smoke. So it's essentially, this is you because his hands are tied behind his back and all these people, all these short sellers are jumping him. It's an ugly thing to see. If you think that's not a possibility, you just allow these financial guys to do whatever they please and they love you for it. But, it all looks a little fishy. It looks like somebody's in their ear telling them to slow them down because they all work under the same umbrella. They're all on Wall Street. They're all interconnected some way, somehow. Like you see in a business where there's one company that owns everything else. That's what it feels like on Wall Street. This is not financial advice. Do as you please. If you want to sell stock, do it. If you want to buy it, buy at your own risk. Volatile stocks move a lot. If you can't handle it, buy something slower. I'm out.